Between 2014 and 2018, the 25 richest Americans saw their wealth grow by $401 billion. The amount they paid in federal income taxes during that same stretch was just about $13.6 billion. That's a true tax rate of roughly 3.4%. Meanwhile, a nurse, a plumber, or a teacher earning $60,000 a year pays an effective federal rate somewhere around 20 to 25%. So what's going on? Is the tax code broken? Or are the ultra-wealthy just playing a completely different game? The answer is both. And the strategy they use has a name. It's called buy, borrow, die. This three-step playbook has quietly become the single most powerful wealth preservation strategy in America. It's 100% legal. It's hiding in plain sight. And by the end of this video, you're going to understand exactly how it works, why it works, and what pieces of it you can start applying to your own financial life, no matter how much money you have right now. Let's start with step 1. Buy. The wealthy don't earn their money the way most people do. They don't rely on a paycheck. Instead, they buy assets. Stocks, real estate, businesses, art. Things that go up in value over time. And here's the critical part. As long as they don't sell those assets, they don't owe a single dollar in capital gains tax. The IRS only taxes you when you realize a gain, meaning when you actually sell and pocket the profit. So if you bought shares worth $1 million and they grow to $50 million, your tax bill is zero as long as you hold on. That's not a loophole. That's how the tax code is written. And it creates an enormous incentive for the rich to accumulate assets and never let them go. The longer they hold, the longer they defer. And deferral, in the world of wealth, is worth its weight in gold. But here's the obvious problem. If you never sell your assets, how do you actually live? How do you buy the mansion, the yacht, the private jet? That leads us to step 2. Borrow. This is where the strategy gets brilliant. Instead of selling their stocks or real estate to generate cash, the ultra-wealthy borrow against them. They walk into a private bank and take out what's called a securities-backed line of credit, also known as an S-block. Here's why it works so well. When you take out a loan, the IRS does not count it as income. It's not a sale. It's not a paycheck. It's debt. So there's no tax. You could borrow $10 million against your stock portfolio and not owe the government a dime. Meanwhile, your assets stay invested and keep growing. You're spending borrowed money, living your life, and your net worth is still going up. And the interest rates the wealthy get on these loans? They're shockingly low. We're talking rates that are often below what the average American pays on a mortgage, let alone a credit card. Banks fall over themselves to lend to someone with $100 million in collateral. The risk is almost non-existent from their perspective. So the rich are buying things, funding their lifestyle, even making new investments, all with borrowed money. No income reported, no taxes triggered, and every dollar of their portfolio keeps compounding untouched. Now, eventually, those loans have to be repaid, right? That's where step 3 comes in. And this is the part that shocks most people. Step 3. Die. When a wealthy person passes away, something remarkable happens in the tax code. It's called the stepped-up basis. Here's how it works. Let's say someone bought $2 million worth of stock decades ago, and by the time they die, it's worth $100 million. That's $98 million in unrealized capital gains. Under normal circumstances, selling those shares would trigger a massive tax bill. But when those shares pass to the heirs, the IRS resets the cost basis to the current market value at the time of death. The $2 million original price tag? Gone. The new basis is $100 million. So if the heirs turn around and sell the stock the next day for $100 million, their capital gains tax is zero. All $98 million in gains are completely wiped from the tax books. The heirs then use part of the proceeds to pay off any outstanding loans their parents had, and they keep the rest. Tax-free. And if they're smart, they start the cycle all over again. Buy new assets, borrow against them, pass them on. Generation after generation, wealth compounds, and taxes never catch up. ProPublica's reporting revealed just how extreme this gets. Jeff Bezos paid zero federal income tax in 2007 and 2011. Warren Buffett's true tax rate between 2014 and 2018 was 0.1%. These aren't criminals. They're following the rules. Rules that were written in a way that favors wealth over income. Now, there's been growing political pressure to close these gaps. Yale's Budget Lab published a study in 2025 analyzing 3 different reform proposals that would target the borrow step. The most aggressive option, treating borrowing as a taxable event, could raise over $100 billion in 10 years. California has even pushed a ballot initiative for a one-time 5% tax on billionaires' net worth. But as of right now, the stepped-up basis is still the law, and the estate tax exemption was just raised to $15 million per person in 2026 under the One Big Beautiful Bill Act. That means a married couple can pass $30 million to their heirs with zero estate tax. And the wealthiest families take this even further with something called a Dynasty trust. These are long-term trusts specifically designed to pass wealth from generation to generation while staying outside the estate tax system entirely. Some states, like South Dakota and Nevada, allow dynasty trusts to last forever. That means a family can fund a trust today, and their great-great-great-grandchildren can still benefit from it centuries from now, without ever triggering estate or gift taxes along the way. It's the buy, borrow, die strategy on a multi-generational scale, powered by legal structures most people have never even heard of. So what does all this mean for you? You're probably not a billionaire, neither am I. But there are real principles buried in this strategy that apply at every level. First, buy assets that appreciate. Stop parking every dollar in a savings account earning 4%. Start building a portfolio of investments that grow over time, whether that's index funds, real estate, or a small business. Second, understand the power of borrowing strategically. You don't need an S block worth $50 million, but using a home equity line of credit or even a margin account at the right time can give you access to cash without triggering a taxable event. Third, think generationally. The wealthy don't plan for next month. They plan for the next 3 decades. Estate planning, trusts, and understanding how assets transfer at death can save your family enormous money, even at middle-class levels. Fourth, and this might be the most important one, stop thinking of taxes as something that just happens to you. The wealthy treat the tax code like a rule book, and they study every page. You should, too. You don't need a team of accountants to understand the basics. Learning the difference between taxable income and unrealized gains, knowing when to sell and when to hold, understanding how retirement accounts and estate exemptions work. That knowledge alone puts you ahead of 90% of people. The buy, borrow, die strategy isn't just a billionaire trick. It's a mindset. It's the idea that the tax code rewards ownership, patience, and planning. The people who build lasting wealth aren't the ones earning the highest salaries. They're the ones who understand how the system actually works and position themselves accordingly. If this changed how you think about money and taxes, hit that subscribe button and turn on notifications. Frankie Finance is here to make sure you're never in the dark about how wealth really works. Thanks for watching, and I'll see you in the next video.